What happens when the experts get it wrong? When the people you trust to guide your investments fumble so hard, it's almost like they're trying to steer you into a brick wall. Today, we're calling 5 analysts to the stand in our Incompetence Court, and they're going to have to answer for some truly disastrous takes on Boeing BA stock. One said it was headed for the skies, another that it was dead in the water, each with a conviction so sure, but BA had other plans. And while these so-called experts were busy getting it wrong, everyday investors, people just like you, were caught in the crossfire. But here's the thing, it's not about a bad prediction. Everyone misses once in a while. What we're talking about is a fundamental misunderstanding of what drives this company, and an even more troubling blindness to the warning signs. How could they miss what was right in front of them? Today, we're tearing their analysis apart, piece by piece. But more importantly, we're diving into what they should have been looking at, and what you need to understand if you don't want to end up the victim of bad advice. If you're tired of so-called experts leading you astray, this is the lesson you can't afford to miss. And if you're fed up with bad advice from supposed experts, consider a new approach. Starting your own YouTube channel could be a fantastic way to boost your income and complement your investing efforts. With Tube Magic by Matt Parr, you'll learn how to use AI tools to create, grow, and monetize your channel, regardless of your experience level. Matt's course provides the strategies and insights you need to turn your channel into a successful venture. Ready to take control of your side hustle? Click the link in the description to get started with Tube Magic today. Boeing BA stock soared to unprecedented heights in early 2019, hitting an all-time high of $430.35 per share. The aerospace giant was flying high on strong demand for commercial aircraft and lucrative defense contracts. But by March 2020, it all came crashing down, plummeting to just $89 per share. A combination of the global pandemic and the 737 MAX crisis sent the stock into a tailspin that no one saw coming. Or did they? Our first culprit of the day in Incompetence Court, Douglas Harned of Bernstein, certainly didn't. With bold predictions and misplaced confidence, he missed the turbulence ahead. As you can see on the chart, Douglas began his coverage of this stock in 2016 with an aggressive outperform call at 176 when the stock was trading at around 121. This was actually not a bad call, and as you can see, he did a pretty good job while the stock was on its climb. But unfortunately for him, he formed an attachment to the success of this stock so much that he ignored the writing on the walls. While he did lower his estimates, he held on for dear life as he stared into the abyss of freefall that his beloved stock was about to jump into. As the stock crashed, Douglas played a game of chase with the stock price, holding on to his overweight call for dear life, only to erratically change his position to neutral and negative for a split second and return to his optimistic call, which he holds to this day. Good job going negative, Douglas, but unfortunately, it was a little too late, and people lost way too much money if they were naive enough to listen to you. We find the defendant guilty of gross incompetence and sentence him to a life of unpaid manual number crunching. Our next defendant in Incompetence Court, Myles Walton of Wolfe, had a similar set of wins on the way up, and an even more of an almost got it right vibe with how he played it. As you can see, Myles made a similar set of buy calls on the way up, but he was beginning to be more accurate with more precision to Douglas just a few months before the peak when he changed sentiment to neutral around 353. Unfortunately for him, he started to regret his honesty just a few months later and made a series of bipolar calls to switch to buy neutral and buy as the stock crashed. To his credit, he did at least change sentiment at the right time, but unfortunately by not going all the way to a sell call, he ended up losing a lot of money for people. Myles, you smelled the blood. Why didn't you go all the way? You were doing so well. Guilty as charged for incompetence. Our next defendant today, Peter Arment of Baird, is being charged with 1 count of incompetence and 1 count of copying Myles' call flow for this stock. As you can see on the chart, Peter started his coverage of this stock in 2013 and has not failed to show gross incompetence yet. Peter touted the stock on the climb, as Myles did, telling investors to buy it like there is no tomorrow, only to change to neutral before the crash, and until slightly after which he returned to positive sentiment, which he holds to this day. Incompetent? Yes. Copying Myles? Yes. Guilty as charged. Our next culprit for the day, Ronald Epstein of Bank of America Merrill Lynch, is being charged with 1 count of incompetence and 1 count of bleeding BAML dry for tens of millions in salary. Ron has been covering this stock forever, and he should have been leading the team to competence, but instead, after almost 2 decades of covering this stock, he has not made his mind up yet. He did call buyback in 2007, but he decided that keeping up with that call was going to be too much work. So from then on, he simply texted neutral calls to his assistant at BAML from his beach house to clock in price targets that more or less chased what everyone else was doing. So let's get this straight, Ron. You have been covering this stock for over a decade, and you can't even make a definitive call on it. At the same time, you do believe that the price targets should have been all over the pace, as shown in the chart. A managing director of BAML, according to salary.com, makes $906,000, and that is just the average. This guy has been around for years, as the chart shows, so we all know he's making much more than that. Let's call it $1 million a year to be fair, and 17 plus years of covering the stock. So they paid him like $17 million to cover this stock, and he has not been able to come up with a definitive decision on it. Guilty as charged for bleeding BAML, dry and gross incompetence. Our final defendant, Cai Von Rumohr of TD Cowan, is being charged with copying Peter and Myles and gross incompetence. Similar story to Peter and Myles touting the stock on its way up, only to move into neutral as the stock crashed. The chart tells the story. No analysis needed. Guilty as charged. We must note here that although our first incompetent analyst Douglas and salary swindler Ron had zero vibe of competence in their calls, the other 3 analysts today would have been given competence awards if they had just gone all the way and given sell calls, where they gave neutral calls more or less. They changed sentiment on the way down, but should have gone neutral as the peak approached and then sold at the peak until the trench. This begin to touch on one of our lessons for the day on how to read analyst calls. More on that in a few minutes. Boeing, BA, is a global aerospace giant, widely known for manufacturing commercial airplanes, defense systems, and space technology. Founded in 1916, the company became a cornerstone of American aviation and defense, with significant contracts from both commercial airlines and the US government. For decades, Boeing was a dominant force, with its stock reflecting its success. However, as we saw in 2019 and 2020, even the strongest companies can face turbulence when they fail to address deep-rooted problems. Boeing's trouble began with the 737 MAX crisis. The 737 MAX, which was Boeing's most popular aircraft model, faced a series of catastrophic malfunctions that led to 2 deadly crashes in late 2018 and early 2019, claiming the lives of 346 people. Investigations revealed critical software issues in the flight control system known as the MCAS, Maneuvering Characteristics Augmentation System, and Boeing was accused of cutting corners to rush the aircraft to market. This resulted in a worldwide grounding of the 737 MAX, leading to massive production delays, lawsuits, and a tarnished reputation. To make matters worse, Boeing was hit by the global COVID-19 pandemic. In early 2020, as airlines grounded fleets and delayed orders, Boeing's commercial business took a severe hit. The pandemic-induced slowdown in air travel, paired with the ongoing 737 MAX disaster, created a perfect storm of financial and operational struggles for the company. Boeing's debt ballooned as it attempted to weather the storm, and its fundamentals began to look shaky. The company posted multi-billion-dollar losses, burned through cash, and took on significant debt to stay afloat. For investors, it became clear that Boeing's balance sheet was under immense strain, and the company's leadership faced criticism for its handling of the crises. In addition to the E737 MAX fallout and pandemic-related slowdowns, Boeing faced challenges in its supply chain, disruptions in global production, and competition from Airbus, further eroding investor confidence. All of these factors combined to drag the stock from its peak in 2019 to a dramatic low in March 2020, where it hit $89 per share. In hindsight, it's clear that the financial and operational cracks in Boeing's foundation were present well before the stock's collapse. The analysts we've discussed today missed or outright ignored these signs, resulting in disastrous advice that cost investors millions. So, back on the analyst neutral blunder that we noted, investors should really begin to read neutrals as buy sentiment from analysts. Why? Because the reality is, analysts rarely want to come out and say sell. The moment they shift from a buy to a neutral rating, they're subtly signaling caution while still trying to keep relationships intact. And that leads us to the bigger, unsaid issue here, the relationship management scene role analysts play with the very companies they are supposed to be scrutinizing. Analysts often rely on maintaining a favorable relationship with the firms they cover, particularly at big institutions, where they serve both as advisors and unofficial relationship managers for investment banks. A sell rating risks souring that relationship and potentially losing lucrative business opportunities. So instead, they choose the safer route, neutral. They signal hesitation without upsetting the company too much, which allows them to continue managing those relationships at the expense of the investor. This is one of the reasons investors need to be cautious when interpreting analyst reports. When you see a neutral rating, it's often a watered-down version of what should be a sell call. And this brings us to a critical lesson on reading these reports. Always factor in the underlying business relationships that might bias an analyst's opinion. Now let's pivot to another lesson on the fundamentals of analysis, one that ties directly to the 737 MAX disaster. One of the biggest red flags that analysts and investors missed with Boeing was the company's increasing focus on cost-cutting and speeding up production at the expense of safety. The 737 MAX tragedy was a direct result of Boeing prioritizing short-term profits over long-term stability and safety. When you're evaluating a company, it's not just about the balance sheet or revenue projections. You need to look at the underlying management philosophy. Is the company more focused on increasing production and cutting corners, or is it maintaining quality control and long-term vision? With Boeing, the warning signs were clear. The company's overconfidence in its ability to quickly fix software issues and their reluctance to ground the planes after the first crash showed a dangerous disconnect between management and operational reality. In your own analysis, always consider the corporate culture and whether a company's leadership is making decisions that sacrifice long-term stability for short-term gain. When that balance tips too far toward immediate profitability, you're looking at a potential disaster, whether the stock price reflects it yet or not. So, always take steps to conduct your own due diligence. If you rely solely on these so-called experts to guide your financial decisions, you might find yourself guided straight into bankruptcy court. Your financial future is yours to manage, and if you must outsource it, be a proactive client. Because if you're a passive one, you may wake up one day with a summons to a hearing in the Incompetence Court. For a deeper dive into one of history's biggest blunders on this front, check out this video, an epic breakdown of the Paycom disaster. Disclaimer: Incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on.